where does money go when it dies? What happens to all the deposit? What does it mean when deposits fall? Where are they going? Who is pushing them away? It's all very sad. And the answer is a big black hole called the Federal Reserve, and we'll illustrate the point as to why the system is inherently exponential and unsustainable and requires increasing amounts of inflation until the system explodes, which it is on the verge of doing, and I will show you how. So first of all, we have this Bloomberg article, $1 trillion Treasury vacuum coming for Wall Street rally. We've talked about this in previous videos. JP Morgan Chase & Co. strategist Nikolaos Panagurtsoglou estimates a flood of treasuries will compound the effect of quantitative tightening on stocks and bonds. This is a very big liquidity drain, says Panagurtsoglou.
My blue barb has broken.
We have rarely seen something like that. It's only in severe crashes like the Lehman crisis where you see something like that contraction. Panagurtsoglou thinks that this is going to be a liquidity drain. But then a guy named Wigglesworth counters and says, well, maybe not. Channeling Louis XV with the title Après debt ceiling deal, le terrible deluge. Gird yourselves. You see here, this is Robin Wigglesworth. I don't make up these names. Somebody else does.
It's frickin' freezing in here, Mr. Bigglesworth.
Here, Wigglesworth gives us some useful context. He says, a bit of context may be useful here. Indeed, it can be. As the Fed tightened monetary policy to combat inflation by rapidly raising the Fed funds rate, we have seen a steady outflow of funds from bank deposits into money market funds, which picked up dramatically after the regional banking problems that began in March. The debt ceiling concerns have added to the cash parked at money market funds, which reached an unprecedented $5.81 trillion as of May 25th. Money market funds, in turn, have deposited their cash at the Federal Reserve using reverse repo purchase agreements, earning the reverse repo rate. What is the reverse repo rate? That is 5.15%. We'll get to that chart in a second. While MMFs are the natural buyers of the deluge of T-bills to come, the yields need to be above the reverse repo rate for them to buy them. This means higher funding costs in the short-term money markets, which in turn would add to liquidity challenges for banks. Either banks will fund this treasury issuance with deposits and deposits will shrink, or the money will come from reverse repos that are now paying 5.15% to money market funds, and it will be liquidity neutral or even liquidity positive if that money is going out of reverse repos into the money system, into the money supply. So what is going to happen? Well, we can figure that out by tracking two things. First, the amount of reverse repos in the system, and second, the amount of deposits in the system, and third, we can track the likelihood of money market funds moving over from reverse repos to treasury bills by looking at the interest rates that are available for both, the arbitrage between them. If the interest rate is significantly higher in treasury bills, then yeah, money will probably move out of reverse repos into treasury bills, back into the money supply as the treasury's general account is drawn down after this raise. So let's see how much money they've raised in the past 2 days, how much money they will raise by the 13th of June, and where this money is coming from. We know that reverse repos pay 5.15%. We have here a 29-day bill for 5.05%. That's below the reverse repo rate, so that's not going to come from reverse repos. We have here a median rate of 5.165%, and we have here 5.18%. Here a 119 bill for 5.3%, and here 5.2% for a 182-day bill. I think that's a 6-month bill. And I think the total on all these auctions something is $250 billion. Now, upcoming, we have this tab. If we click on upcoming auctions, we have all these 17-week, 4-week, 8-week, 13-week, 26-week, and 52-week bills, right? All auctioning from June 7th, which is tomorrow. I'm recording this on June 6th, until June 13th, so 1 week. It's probably going to be about the same amount as the 5 auctions that were just finished, about 250 billion. So 250 billion plus 250 billion is about 500 billion. That's about $500 billion being dumped onto the market worth of treasuries in about a week. Now, thankfully, we have a daily chart for reverse repos, if this number starts to fall from, it's now at 2.131 trillion, if it starts to fall by hundreds of billions of dollars, then we'll know that money's coming out of reverse repos and going into the Treasury's general account, and they will use it to pay off whatever bills they have to pay, and the money will go back into the money supply. Or we can also track this chart. This is deposits at large domestically chartered commercial banks. You see here we are at a high of 11.55 trillion on April 13th, 2022. We are now at 10.633 trillion and still falling as of May 24th. If this number falls significantly, then we have deposits from banks being used to buy all these treasury bills, and that will bring the money supply down further. Where does the money go? Where do the deposits go when they fall? How can you have deposits of 11.55 trillion, then 10.66 trillion? Where are the missing deposits? Where did they go? Why aren't they here? Why don't they exist anymore?
Man up and vanished like a fart in the wind.
In a very basic sense, you have a Federal Reserve, a central bank that buys debt, its asset on its balance sheet, and issues dollars. Let's say that it buys a bond for $100, maturing in a year at 10% interest. The very first time that the Federal Reserve did this at its founding in 1913, whatever that bond was, they bring $100 into existence, and on that bond, $110 is owed eventually back to them. The problem is there aren't $110 in existence, right? There's only 100. So what does the Fed do to make sure that that asset can be paid off and the money retired? Well, it simply buys another bond. Let's say another $100 bond for a 1-year maturity, 10% interest, and it issues $100 for this bond. In exchange for this bond, now there are $200 in the money supply in the monetary system, and the first bond owed $110 to the Fed to be taken out of existence can be paid back. But after that is paid back, what do you have? You have $90 left, $200 money supply minus 110 paid back to the Fed. $90 left to pay back a $110 debt when the next bond comes due. So instead of a $10 deficit, you have a $20 deficit, and the situation gets worse. So what does the Fed do? It buys another bond and another bond and another bond. And every time the deficit gets wider and wider as to what is owed to the Fed versus the amount of dollars in existence, and you have a dollar squeeze. So what can the Fed do to lengthen the runway? Well, it can lower interest rates, because when you lower interest rates, you have to pay more money for the bond. The Fed pays more dollars into the economy in exchange for that bond, and they get paid less interest back. So the deficit between how much is owed back to the Fed and how much dollars are in existence shrinks by lowering interest rates. This is why the Fed has to lower interest rates periodically to stay on the curve. The other thing they can do is they can lengthen maturities. If instead of buying a one-year bond with a 1-year maturity, they buy, let's say, a 5-year or a 10-year bond, then in 5 years and 10 years, only then does the principal have to be repaid. And the whole sham, the whole farce, the whole circle, the whole hamster wheel can continue on and on and on. But eventually it has to stop. At a certain point, the exponential curve that feeds this system goes vertical, and that is the point of hyperinflation when the currency is dumped. This is Rafi of the Endgame Investor. If you're interested in checking out the Endgame Investor, where I track this stuff in detail on a nearly daily basis with a weekend report, then click on the link in the description below and get a 2-week free trial, or become my patron on Patreon, where we talk about biblical concepts of money and economics. And this week we're doing why nervous breakdowns are necessary. No matter how close to God one is, there's always nervous breakdowns, and there's always rebuilding after those happen, even with monetary systems and societies and everything else that we've known in human existence.
So does anybody really wonder why anybody is hanging on to sanity by the atoms on the tips of their fingernails while life dirty dances on their digits? And is it really any wonder that I seem deranged?
See you guys next week.